Hey everyone, we're going to give just another minute or so. We have a few people still entering the meeting. We'll get started here shortly. Okay, everyone. This is Joe Page. I'm the managing partner of the Whitlock Company. Looks like most people that RSVP'd are in the session now, so we'll go ahead and get started. Just real briefly, before I turn it over to the presenters, a couple of housekeeping items. Please remain muted during the presentation. We'll have probably a little over 50 people in here, and if there's any background conversations or anything going on, it's going to make it difficult to get through the materials. In the GoToMeeting, if you can minimize the participants, if it's showing up on your screen, it'll, especially if you only have one monitor, it'll make the presentation a little easier for you to see. And also the chat bubble, if you have questions, we ask that you submit them through the chat feature, or you can also email me. My email address is on this screen. At the end of the presentation, I'll have that email address back up there again. Again, because we're going to have about 50 people in here, a lot of material to cover, I'm going to ask that you go ahead and submit your questions, but we will probably refrain from answering them until the end of the presentation so we can get through the material and then we'll come back to the questions. One important reminder here, the information that we're presenting today is current as of yesterday, May 13th, subject to change as the Treasury Department, Small Business Administration, and Internal Revenue Service publishes additional guidance and rules. In particular, the Treasury Department and SBA, there was a little bit of additional guidance published even last night. So it's a little bit of a moving target. So keep in mind what we're talking about today is current as of last night, basically. The agenda today, Steve Johnson, tax partner in the Kansas City office, is going to talk about what we know about at this point of the Payroll Protection Program loan forgiveness piece of that program. Dave Myers, the tax partner in Kansas City office, and will then go over some of the other Payroll Protection Program rules, some IRS issues, loan certification rules, possible audit and review, and other unknown issues at this point. Then Melinda Thurman, a partner at Springfield, a partner in the Small Business Services Department, will go over some of the payroll provisions of the various acts. And then Jennifer Cochran, tax partner in Springfield office, will talk about some aspects that are outside of or in the CARES Act, but relates to individuals, retirement plans, charitable contributions, and so forth. And again, a lot of detail. We're going to try to be respectful of everyone's time, get through the material, but again, we will definitely try to get to everyone's questions at the end of the session. With that, I'm going to turn it over to Steve Johnson. So Steve and Dave, if you can unmute yourself and take over.
All right, thank you very much, Joe. Good morning, everybody. As Joe mentioned, I'm going to spend a little bit of time talking about loan forgiveness here. And as he pointed out, final guidance has not yet been issued. As part of the CARES Act bill, the legislatures gave them 30 days to get their final guidance issued. That has not yet been issued, so we're still waiting for that. So what we're going to talk about today are really kind of best practices and recommendations. So we'll spend the next 10 minutes or so walking through the steps to prepare for loan forgiveness at the end of the 8-week covered period. and then we'll follow that up with some recommendations on documentation that you should be maintaining to gather along the way here. So real quickly, the 5-step process for loan forgiveness. This is just a snapshot, kind of all in one place of the 5 steps. We'll get into more detail on each of these steps in the following slides, but really at a high level, obviously the first step is just to track our eligible costs. Steps 2, 3, and 4 will deal with potential reductions in the amount of forgiveness, and step 5 provides the criteria where we're really allowed to ignore steps 3 and 4. A little confusing, but we'll jump into that here in a minute. So, obviously step 1, is really the process of just tracking our total eligible costs incurred and paid during this covered period. So again, what are eligible costs? That would be payroll, mortgage interest, rent, and utilities. As you can see, payroll costs are defined pretty broadly, really to include, all compensation, benefits, retirement plan contributions, state unemployment, all those types of things that we were gathering when we were going through the application process. Again, for mortgage interest, rent, and utilities, it's just important to point out that those agreements or services had to be entered into prior to February 15th. Just a couple things to think about too when we talk about payroll, or reminders here. Independent contractors are not included. There was some confusion early on about that, but they came out with some guidance after the fact that said, basically allowed those independent contractors or self-employed individuals to apply for their own PPP loans, so they would not be included as part of the employer's calculation. We've kind of come to find out through the weeks here since the bill's been passed that many national payroll providers have developed some reports to track payroll benefits and FTEs. So if you outsource your payroll to a payroll provider, you want to make sure you contact them to see what information they may have available for you already. And also, we were recommending early on that a separate PPP bank account, could be used to help track in some of these costs as well, just to keep things a little bit cleaner. In a perfect world, after step 1, and we've calculated all of our eligible costs, we would know the amount of loan to be forgiven. But as I mentioned, steps 2, 3, and 4 deal with some potential reductions in the amount of forgiveness. So step 2 is really to calculate your payroll cost forgiveness floor. So you may have heard of this 75% rule, but essentially 75% of eligible costs need to be used on payroll, right? And if it's less than that, then your forgiveness is reduced by that amount. So for example, if you had $100,000 of eligible costs, at least 75,000 of those would need to be used to cover payroll. If whatever you're using, you only spent 70% on payroll, then that difference, or $5,000 in this case, would not be forgiven. It's also important to note that this provision was not included in the bill. This rule was added by the SBA and the treasurer after the fact, saying it was appropriate in light, the Act's overarching focus to keep workers paid and employed. And just to highlight some of the, some of the moving targets here. Last week on May 8th, the SBA's Office of Inspector General issued a report that found, the SBA wasn't in compliance with the bill, saying the 75% rule was not the intent of the law. So again, what we know today, the 75% rule still applies until we get additional guidance. I think that last bullet point just helps highlight some of the confusion and a little bit of the moving target that's currently happening. Step 3 in the process would be to calculate any percent decrease in FTEs from your 8-week covered period. So For example, if you had a 15% drop in FTEs, that would result in a corresponding 15% decrease in the amount of your loan forgiveness. And again, for purposes of determining that decrease in FTEs, you can see the relevant dates that are listed there below. You need to compare your average FTEs during this 8-week covered period, as they've defined it, with either February 15th through June 30th of 2019 or January 1st through the end of February 2020. They do allow some flexibility where you can choose whichever date gives you the best answer. Step 4, or the final potential reduction in the amount of forgiveness, is you need to calculate any reduction in payroll greater than 25% of your prior quarter. So first of all, this obviously only applies to employees that make more than $100,000. Then really the question you have to ask yourself on those remaining employees, was their payroll during the covered period more than 25% less than it was the previous quarter? And if so, you have to reduce your forgivable amount. So again, presumably that previous quarter would be Q1. If everybody got their funds here in the second quarter, you'd be comparing it to your January, February, March quarter. And then step 5. So step 5 is where you calculate any adjustments because your FTEs and salaries and wages were restored prior to June 30th. So, again, there's been a lot of discussion, regarding, you have to spend all of your money during this 8-week covered period after you get the loan. But written into the bill, they did provide an exemption if you're able to restore those wages or rehire those employees by June 30th. And again, as we've noted down there and read below, there really is no guidance out yet on how this will be implemented. So, that's one of the bigger questions we have on how they're going to implement these rehire exemptions. They did provide a little bit of help last week. They issued a new frequently asked question, number 40, regarding an offer to rehire declined employees. And as you can see here on the FAQ, essentially the question is, will the borrower's PPP loan forgiveness amount be reduced if the borrower laid off an employee, offered to rehire, but the employee declined? And they came back with no, that the Treasury intends to issue an interim final rule excluding laid off employees who you offer to rehire from the loan forgiveness calculation. Again, important to note, the borrower must have made a good faith written offer, so documentation is important, and the employee's rejection of that offer must also be documented. So again, documentation. So that covers the 5 steps in the loan forgiveness process. And next, we're just going to quickly discuss some required, or at this point, since we have no guidance, recommended documentation to gather along the way here. So, obviously payroll tax reports will be key here. And again, if your organization contracts with a payroll provider or you're part of a PEO, a professional employer organization, you can supply reports that they would have for you reflecting the employment tax returns that are filed. Item 2, we need to maintain or provide documentation for compensation and FTEs. So, in general, your payroll reports will probably provide some of that stuff. But, at a high level here, obviously, your gross wages during this 8-week covered period, as well as that, first full quarter to be able to compare if you had a reduction in wages. Important to identify employees that were making over the limit of $100,000. State unemployment. There's 3 important dates that we need to determine. FTEs, or your full-time equivalents, during those periods of time listed there. And then again, there's also some exceptions or different rules for seasonal businesses. Quickly, 3, 4, and 5 here on the next page are the group term healthcare benefits, retirement plan benefits, et cetera, that we need to maintain documentation for all the payments that we've made with regards to that. And again, for mortgage interest, lease payments, utility payments, et cetera, we need to provide, lease documents, bank statements or mortgage interest statements, utility bills, et cetera, to be able to document that we made those payments. And then secondly, for self-employed people that were allowed to apply for these loans, you need to substantiate your net income by providing your Schedule C for 2019. And if you're self-employed, but you also have employees that were eligible for the PPP loan, we need to provide all that same employment information that we discussed previously, as well as any documentation for your other expenses. If you're deducting, mortgage interest, rent expense, utilities, et cetera, we still also need to provide that same information. Some of the common questions, concerns, really unknown items until we get final guidance that we get a lot of calls on, again, would be, how will this rehire exemption be applied if employees are rehired after this 8-week period, but before June 30th? I mean, it's allowed for in the bill, but we just have not seen any guidance of how this will be implemented. How will bonus payments, salary increases, profit sharing contributions paid during the covered period be factored into loan forgiveness? Again, some employers may currently be paying bonuses, quarterly, or making profit sharing contributions quarterly. But the question is if you haven't done it in the past, can you start paying bonuses, for example, in the second quarter or third quarter, if that helps with your loan forgiveness? We just don't know. We spent a lot of time talking about FTEs, but the CARES Act did not actually define how you determine an FTE. So it'll be important to find out how they're actually going to define that. We've also seen a lot of recommendations and commentary over the last few weeks as well. Will or could the 8-week covered period be changed to align with the beginning of a pay period? Obviously, that may help facilitate a more consistent approach to trying to tie out some of these numbers. And then the last one will be interesting too is, will or could the 8-week covered period be changed to begin when operating restrictions are lifted rather than the date loan proceeds are received, rather than avoid limiting the use of funds to a time period when they're not permitted to operate, the businesses can't operate. So I mean, clearly there's a lot of questions, concerns, and unknowns out there with regards to loan forgiveness. We're hopeful that we'll see guidance from Treasury soon, and when we do, we can certainly get back to you with more information. So with that, Dave, I will turn it over to you.
Dave, before you get started, just real quick, can everyone make sure that their camera is turned off, that they're not sharing their camera, and again, remain muted? Had a couple of people say they're seeing other people instead of the presentation. So please turn your cameras off. And then I sent a chat. There's been several that have asked for the slides. The slides will be made available. I put in the chat. You can just email me. We'll get those slides out to you after the presentation. Sorry about that, Dave. Go ahead.
Okay, thank you, Joe, and thanks, Steve. I was thinking last night what this is like, and of course the whole world has changed, and this program is brand new, and I came to the conclusion it's not like anything, but there's a pretty good analogy. And if you can think in your mind where about the Peanuts cartoon strip, and then think about when this program first came out, they said, all you have to do is say you had economic uncertainty about the world now, and you have employees and you qualify for this PPP loan. And not only do you qualify for the PPP loan, it's not going to be taxable. And Mnuchin stood up, and we probably all saw the quote of, this is the best thing since sliced bread. Well, imagine the first time Lucy teed up the football for Charlie Brown to kick. Charlie had full trust in Lucy. And, of course, he goes to kick it and she pulls it away. So he has a little less trust in Lucy. And then the next time she does it, she says, no, really, I mean it this time. Come kick the football. And of course, she pulls it away again. Well, what we have now is multiple Lucys. We have the Department of Treasury, the SBA, Congress, and the IRS all changing rules as we go along. And here are some of the other significant rules that we have. The IRS, I noticed regarding taxability, loan certification rules, possibility of auditor review, and some other unknowns. So we'll cover those. And the first Lucy would be the IRS. And in the bill, it clearly stated that loan forgiveness is not taxable income. Well, as most of you know, the IRS said, well, that's true. Loan forgiveness is not taxable income, but anything you would normally deduct with the loan proceeds that are forgiven is not deductible. So the exact same number has now become taxable income. Now, you don't have to include loan forgiveness as income, but you have to make an add back for the deductions it paid for. So the same number of loan forgiveness as of now with the guidance we have is going to be taxable income. Yesterday, a bipartisan bill was introduced in the Senate to make sure that that IRS ruling is overturned. And the House leadership also has indicated that that they did not intend this result. So we may see a change there. Back to it isn't taxable. And then there's the whole thing about need and the definitions of that. Of course, when you got the loan, it was basically, you had to do number 2 on this slide, just say current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant, which is not a very high standard to meet. And I think we can say almost all, if not all, of our clients do meet that standard. But then, some bad press, and large public companies taking the money, they came out and said, well, if you had access to capital otherwise, you didn't really need this loan to support the ongoing operations of your business. So you should give it back, and if you do it by a certain date, then we won't penalize you. And then that got everybody worried. Okay, well, did I really need the loan or not? Well, how are they going to judge it? So the next thing they did is they talked about private companies. And they said, well, if you're a private company and you had adequate sources of liquidity, use the same rule that we published for the public companies. So it got worse and worse. And really, I don't trust Lucy at this point at all. And all our clients are thinking, well, maybe I should give my money back. But then she teed up the football again. And I think it was yesterday. Yeah, this was yesterday as well. They said if your loan's under $2 million, they're essentially going to assume that the required certification was made in good faith. So anybody with a loan of less than $2 million now, it doesn't mean if your loan gets reviewed that it couldn't ever be taken away. It just means the assumption is going to be that you acted in good faith. You would not get penalized, but there's a possibility you would have to pay the loan back. So again, that was yesterday. Also, after 5 o'clock yesterday, it may have been this morning, I don't know, it was a May 15th deadline, I believe. That's been pushed back until Monday. So if there is anybody still considering repaying the funds, you have until Monday to do it without penalty. But again, if you're less than 2 million, it's assumed that you made it in good faith. They've also made it clear there will be some kind of a review of all loans over 2 million. They've referred to it as an audit. We don't know the extent of what it will be, but they've been pretty clear that they'll at least take some kind of a look at any loan that was approved in excess of $2 million. There's a few other commonly asked questions that we don't know the answer to that are listed here. They do talk about PPP loans can only be used for certain qualifying expenses, which are your payroll and utilities and rents and the like. And the forgiveness is an 8-week period. And the rest is supposed to turn into a loan, but I guess, or we're thinking that means you would still have to spend the money on payroll, rent, utilities. It would just be outside of the 8-week period. And whatever you spend outside of the 8-week period would turn into a loan. If you don't spend it on those things at all, then we're thinking you have to pay it back. Again, there's no concrete guidance on it, but that's a common question. Also, some people have received economic injury disaster loan grants. In part of the law, it says that PPP funds forgiveness should be reduced by that grant. Other parts say if you use that grant on non-PPP expenses, that you should not reduce your forgiveness for that. So we need guidance there. And we do have an ever fluctuating economic disaster loan rules. They've changed 4 or 5 times since this crisis has began. And we really don't know how they'll interact with PPP. And we really don't know how to get the loan or who can get the loan or what the cap is, to be honest. It's just seems to change every week. We do know they did put more funding in with this last round of funding. And then there is also a very interesting lending program through the Fed called the Main Street Lending Program that has some very generous terms for business loans. And the Federal Reserve will guarantee or back 95% of the loans to banks. We want you to know that is coming. I don't know of any banks that are ready to make that loan, or even if they have the ability, but there may be an additional round of true loans, permanent financing, that is coming. And again, we do not know how that would interact if you did take the PPP funds. So those are just a few various type things that are not related to loan forgiveness that are big questions. And with that, I will kick the ball to Melinda, and she will talk about the payroll provisions, which are very overlooked, by the way. There are really some nice payroll tax provisions in the bill. So Melinda, off to you.
Thanks, Dave. So I'm going to be discussing the payroll provisions that have been issued. And like Dave said, there is an overwhelming amount of provisions that are out there, and they seem to have been overlooked. The takeaway, hopefully after this part of the presentation, will be at least you'll get some information on what the different credits are, and then also how they tie in with the PPP loans that small businesses have received. So the agenda for this will be the Families First Coronavirus Response Act, which is the 2 federal required leave, which is the qualified sick and qualified family leave. These are refundable payroll tax credits, and this part of the payroll provision is not affected by the Paycheck Protection Program. Then the other 2 payroll provisions we will discuss are the employee retention credit and then the deferral of the employer portion of Social Security tax. Now, do keep in mind that for these 2 credits, the eligibility is limited if you received that Paycheck Protection Program. So just keep those in mind as we go through these slides as it applies to your organization. The Families First Response Act was enacted on March 18th, and then the CARES Act followed that on March 27th. And both of these acts were established to provide the 2 federal paid leave requirements and then the multiple forms of payroll tax relief, and then of course the ability for the forgivable loans. So the first of the 2 required federal leave acts were the paid sick leave. The requirement here is to provide this leave related to COVID-19 to employers with fewer than 500 employees and all public sector employers as well. So this is available to full-time employees for up to 80 hours and part-time employees, which is calculated on the average of number of hours they work or are expected to work over a 2-week period. The date range for these wages are April 1st through December 31st. And these wages are not subject to the employer portion of Social Security tax. Now, in order to an employee to qualify for this paid sick leave, there are 6 conditions for an employee's eligibility. That the employee cannot be at a work site in person or telework. I'm going to go through these 6 conditions, but keep in mind that an employee only has to meet one of these to qualify. So the employee is either subject to a federal, state, or local quarantine or isolation related to COVID-19, or they have been advised by a healthcare provider to self-quarantine related to COVID-19, and they are experiencing symptoms and seeking a medical diagnosis. The employee is caring for an individual who is subject to a governmental quarantine or isolation under COVID-19 or whose healthcare provider advised that person to self-quarantine. The employee is caring for his or her child due to the closure of the child's school or child care facility or the unavailability of a child care provider due to these precautions. And then the 6th condition is the employee is experiencing any other substantially similar condition specified by the Secretary of Health and Human Services in consultation with the Secretary of the Treasury and Secretary of Labor. So there are maximum limitations on these conditions, and they have grouped it into the condition 1 through 3. So if you're quarantined, if your healthcare provider has advised you to quarantine, or you're showing symptoms and seeking the medical diagnosis for COVID-19, then your rate is just your regular pay, but there is a limit of $511 per day, and this is only for 10 days maximum. So it's just basically your 2 weeks. The maximum credit is the $5,110. Condition 4, 5, and 6 are in a different category. So this is relating to caring for your child or the substantially similar conditions. So this is based on 2/3 of the regular pay. The limit is $200 a day, and it's for the maximum 10 days with a maximum credit of $2,000, except for condition number 5. If you are caring for a child due to school closure or child care facility, there is the family medical leave that is in addition to that. So that is why condition number 5, you see the maximum days of 60, and then you see the split of 2,000 maximum credit for sick leave, and then the 10,000 for the qualified family leave. When you're looking at your employees and determining how to base it on how many hours, if they're full-time, that's the easier one. It's just your 80 hours. If you're part-time, for the sick leave, it's an average number of hours over the 2-week period, or the family medical pay is the number of hours that they would normally have been scheduled to work. So the second one of these 2 federal leave requirements is the public health emergency leave, which is the qualified family leave. So this requirement is for private sectors with fewer than 500 employees, and not all public sector employers are included in this. There is an exception of some federal government employers. So the qualifying leave consists of up to the 10 days of unpaid leave, and then this one covers that 10 weeks of paid leave. So an employee could get paid for those first 10 days, those first 2 weeks, if they qualify under the qualified sick leave in one of those 6 conditions that we previously discussed. The qualifying employee is one who cannot work or telework because they need to care for their child that's closed, their child's school is closed, or child care facility is closed or just unavailable because of COVID-19. The date range for the qualified wages, is the same as the qualified sick leave. It's April 1st through December 31st. And then this one is the same as the sick leave as well, that it's not subject to the employer portion of Social Security tax. Now, for this qualification, employees must be provided the leave if they worked for their employer for at least 30 days. The family leave has that requirement. The sick leave does not have that requirement. So on the family leave, just remember that the employee would generally be paid at least 2/3 of their regular rate, multiplied by the number of hours they would normally work. And then the maximum amount per day is $200 for a total of a $10,000 credit, which is your 10 weeks of pay for the family leave. There was an exemption that they came out with to say if you were an employer with fewer than 50 employees, that you could be exempt from this requirement if it would jeopardize the viability of the business as a going concern. So the refundable payroll tax credit portion of this, for this qualified sick leave and the qualified family leave, is the credits can be directly applied against the employer and employee portions of Social Security and Medicare taxes and your federal income tax withheld. Again, they're based on the date range, April 1st to December 31st. The date ranges are very important to keep track of, and they are not available to the federal, state, or local employers. They also had a statement that said the employees are to provide written requests of eligibility to their employers. So an employee should be giving you a written document containing their name, the date or dates that they are requesting leave, a statement of the COVID-19 related reason the employee is requesting leave and written support for that, and a statement that the employee is unable to work and why for such reason. So just make sure that you do have that on file for any employees that are on this leave. So the total credit is calculated based on the sum of 100% of the qualified leave wages paid to the employee. It includes the employer's qualified health plan expenses incurred to provide and maintain coverage for the employee during that period, and the employer portion of Medicare tax imposed on that qualified leave payments. So that wraps up the first two federal required leaves as part of that Families First Coronavirus Response Act. Then we're going to go ahead and go into those other provisions. So the first one is employee retention credit. So this credit was established to retain your employees and continue to pay them. This credit, again, may be applied directly against the employer and employee portions of Social Security and Medicare tax and the federal income tax withheld. And these are filed through either your quarterly Form 941, or you can request an advance refund by filing Form 7200. And the dates for this credit for the qualified wages is from March 13th through December 31st. So if you are filing your 941, March 13th through March 31st fell in the first quarter. The IRS is saying if you paid wages during that date, you can go ahead to get the credit for that date range, March 13th through 31st. You can actually add those to your second quarter 941. Self-employed individuals are not eligible for this credit for their own self-employed earnings, but if they have other employees that they're paying, then they may qualify for this as well. And then on the employee retention credit, the qualified wages would not include any qualified leave wages required under the Families First Act. The employee retention credit, it's calculated based on 50% of the qualified wages, including the qualified health plan expenses that the employer paid. The maximum amount of those qualified wages per employee for all quarters is $10,000. So in essence, the maximum employee retention credit per employee is $5,000. So I just had a quick example to say if an employer pays an employee $8,000 in wages in quarter 2 and $8,000 in quarter 3, then the credit available in quarter 2 is the $4,000, but then quarter 3 there would only be $1,000 credit because of that overall limit of $5,000 per employee for all quarters. To be eligible for the employee retention credit, the employer has to be carrying on a trade or business in 2020, and the employer fulfilled one of the following conditions, either the business suspension condition or the gross receipts condition. Keep in mind that the business suspension, essential businesses might not qualify for this condition. There are some exceptions, but they did make sure that they addressed that essential businesses might actually not qualify. And the gross receipts condition is just a decline in gross receipts of more than 50% compared to the same quarter in the prior year. So there's two different ways this is calculated. There's actually a calculation for more than 100 full-time employees, and then a calculation up to 100 full-time employees. So the average of more than 100 is qualified wages for those paid to an employee not providing services due to those two conditions, the business suspension or significant decline in gross receipts. The wages cannot exceed the amount the employee would have otherwise been paid during the 30 days immediately before that period. And payments for paid time off for vacations, holidays, sick days, and other days off are not considered qualified wages. The IRS is viewing this as that represents benefits that were accrued before the period. And then if for the other part of this of up to 100 full-time employees, the qualified wages were those paid to an employee regardless of whether the employee provided services or not. So it would be any employee while they were under those two conditions. Full-time employee means an employee who had an average at least 30 hours of service per week or 130 hours in a month. This is where this one ties in with that Paycheck Protection Program. So an employer cannot apply the Employee Retention Credit if the employer acquires a loan through the PPP, regardless of the forgiveness. Before I move on to that last payroll provision of the deferral, I just want to mention that even though both of the Families First Act and the Employee Retention Credit, they both include the qualified health expenses, but for the qualified sick and family leave, the qualified health plan expenses are not included as wages for purposes of that $5,110 credit maximum. Whereas for this employee retention credit, those qualified health plan expenses are included as wages to reach that $10,000 maximum wage cap. Form 7200 is a new form that the IRS has issued where you can get an advance payment of your employer credits for these refundable credits. So you can either wait until you file your quarterly 941, or you can file this Form 7200 multiple times for a quarter. So the last payroll provision is this deferral of employer portion of Social Security tax. So this applies to the employer total portion of Social Security tax, or 50% for self-employed individuals that would normally be paid during March 27th through December 31st. So what would happen is the employer would deposit half of the deferred amount by December 31st, 2021. And then the other 50% of that would need to be paid by December 31st, 2022. And this is a separate form of relief in retaining employees of the other 3 refundable payroll tax credits. An employer is ineligible for this deferment, though, if it not only acquires a loan through the Paycheck Protection Program, but also acquires the forgiveness of all or part of it. And now this preclusion is only applicable for deposit deadlines on or after the date the employer receives a decision from the lender on the PPP loan forgiveness. So before I turn this over to Jennifer Cochran, there's lots of date ranges, different rules for them. If you have an outside payroll provider, they will be able to help you with this, or we can help you here in the office as well. So I'll turn it over to Jennifer Cochran.
Okay, thank you, Melinda. That's a lot of information. I will be covering highlights of the CARES Act that pertain to individuals and businesses. One of the highlights is the recovery rebate. The rebate amounts are $1,200 for individuals, $2,400 for joint filers, with a $500 credit for each child. The threshold amount is based upon 2018 adjusted gross income, unless a 2019 return has been filed. And the phase out begins at $75,000 for single filers, $112,500 for head of households, and $150,000 for joint filers. The Secretary of the Treasury is directed to provide the rebate as rapidly as possible. If you are receiving Social Security payments, your rebate check will be deposited into the same account that you receive your benefits. These payments should have gone out the last week of April through the first week of May. If you need to check on the status of your payment, you can go to the irs.gov, get my payment. You will need your Social Security number, AGI, and tax due or refund from your 2019 return. If you haven't filed your 19 return, you will use the amounts from your 2018 return. If you don't receive your payment in 2020, the rebate amount will be added to your refund or reduce the amount owed on your 2020 tax return in the form of a credit. The bill waives the 10% penalty on all early withdrawals up to $100,000. Catch up here, sorry. The bill waives the 10% penalty on early withdrawals up to $100,000 from qualified retirement plans for coronavirus-related distributions. Coronavirus-related distribution is made to an individual or spouse of the individual diagnosed with COVID-19 with a CDC-approved test, or to an individual who experiences adverse financial consequences as a result of quarantine, business closure, layoff, or reduced hours. The tax on this early withdrawal can be paid over 3 years. Taxpayers will be allowed a above-the-line deduction of $300 for contributions in 2020. If you itemize, you will be allowed an unlimited deduction for contributions that are normally subject to 60% limitation. Please note that this is for cash contributions only. Under the CARES Act, net operating losses arising in tax years beginning in 18, 19, and 2020 have a 5-year carryback period and unlimited carry-forward period. The provision limiting an NOL deduction to 8% of taxable income does not apply to the NOLs arising in these years. Tax Cuts and Jobs Act limited the allowed business losses that could be deducted to $500,000 in 18 for married filing joint and $250,000 for single filers. The CARES Act removes the limitation and allows for unlimited business losses for years 2018 through 2020. If the loss was limited in 18, we can go back and amend the return. They finally corrected the oversight made on the Tax Cuts and Jobs Act bill, which made qualified improvement property 39-year property. The CARES Act changes the life on qualified improvement property to 15-year property and is now eligible for bonus. This change is effective as of January 1st, 2018. Qualified improvement property is defined as improvements to an interior portion of a non-residential building after the building is placed in service. It does not include enlargements, elevators, or other structural improvements. We have the option of amending the returns filed or preparing Form 3115 and taking the 481A adjustment in the year that the form is filed. The Form 3115 can be filed in year 2019 or 2020. An example of this is if the qualified improvement property was placed in service in June 1st, 2018, we can either amend the 2018 tax return or file Form 3115 and take the 481A adjustment in either 2019 or 2020. This concludes my presentation on the CARES Act as it pertains to individuals and businesses. I'll now turn it over to Joe.
Thanks, Jennifer, Melinda, Steve, and Dave as well. I mentioned we would try to hit questions here at the end. Surprisingly, I've only got one question that's been submitted through chat or email. And Steve, this is for you, I believe, if you want to unmute yourself. Question is our opinion on work comp premiums in that 8-week forgiveness period, whether we think that is going to be part of the calculation or not.
Well, I think at this point in time, based on the guidance that we've seen, I don't believe that will be counted. But, you know, like a lot of this stuff, I think we're going to have to wait for further guidance to come out where they really lay all this stuff out for us.
Okay, thanks, Steve. We do have a few minutes here where we'll go ahead and stay online here for a bit. If you have questions, feel free to submit them in the chat here for the next few minutes or send me an email or reach out directly to your contact here at the Whitlock Company if you're an existing client. So we'll hang on here for just a few minutes and see if anyone else has any other questions. I will also mention that several of you requested the slide deck. I will get that out to you in PDF form later today. We'll also work on getting this out to our website. And today's session has been recorded. We'll try to get that out on our website fairly soon as well. Additionally, as further guidance is issued, we will be posting that to the blog section of our website as quick as we can. We can get the information out there. So please do monitor our website, in particular that blog section, for updates as they come out from SBA, IRS, and so forth. Do have a couple other questions that have come in. Is equipment loan interest able to be used in the forgiveness calculation?
Yes.
And it's our
Well,
understanding.
I think the question would be yes. The way the law is written, it says, mortgage interest on real or personal property. So I would suspect if you've got personal property secured by a loan, that would probably qualify.
I think it qualifies for spending funds, but perhaps not for forgiveness. Wasn't that the one thing that they were not going to forgive interest?
Yeah, it just highlights another reason why we need to see more additional guidance because,
Right.
We're just a little bit unsure at this time, I think, until we see additional rules.
Another question, is there a time frame and process for submitting and determining forgiveness of the PPP loan?
Yeah, as written in the bill, after the 8-week period, when the borrower goes to their bank to apply for forgiveness, the banks are supposed to have 60 days to kind of process that request. So 60 days from the time you go in and apply for forgiveness.
Okay. Is there an expected date for further guidance to be published?
All we
We
know.
were muted. Yeah,
Oh.
Steve said 2 weeks ago that their deadline was 2 weeks ago.
Yeah, they missed their deadline and they haven't come out and said they're going to provide this by X date.
Okay. Last question that's up here so far, can you elaborate on payment of monthly performance commissions? The first quarter payroll is 13 weeks. Do we average the 13 weeks and use that as a basis for 8 weeks?
Yeah, good question. Again, I probably could have filled up 2 or 3 pages of unknowns or questions when I put my materials together. But yeah, in fact, one of the suggestions the AICPA had proposed to Treasury was dealing with this very same issue. When you look back at that prior quarter, obviously by default you got more wages in that 12-week quarter than you do in, 12-week quarter than you do in the subsequent 8-week covered period. So we're assuming the guidance will come out and say it'll be a weekly average over those time frames. But that's not how it's written, but we're hopeful they'll clear that up. So.
Okay. Not seeing any more questions. We are pretty close to straight up an hour. I think we will go ahead and call it a wrap here. Again, apologize that there are so many unknowns, in particular on the forgiveness side of the PPP loan, but we are monitoring it very regularly, several times a day. We're watching for additional guidance, and as I mentioned, we will get that pushed out to our website on the blog as soon as possible when significant guidance does come out. Again, I will email this slide deck to those that have requested it, and we'll be working on getting it, the presentation posted out on our website in the coming days. And thank you, everything. With that, we will call it a wrap.